charitable giving and its effects on tax planning on this edition of WealthWise. Hi and welcome. I'm Deanne Rosso, President and CEO of Elevate Wealth Advisory, an independent financial planning and wealth advisory firm focused on giving you practical and actionable advice to move your plans forward. Over the last several episodes, we've walked you through 4 keys that we need to pay attention to as we're working through the 4 stages of retirement. And today, we're going to give you some bonus information about charitable giving and tax planning. So obviously, for those of us who are philanthropic, we give out of the kindness of our hearts and because there are organizations that we feel compelled to support. But we can also do that and at the same time get a tax benefit for our gifts. The Tax Cuts and Jobs Act of 2017, which is the current tax structure we operate under, did away with a lot of itemized deductions. And then it also increased the standard deduction. And for many retirees, it increased the standard deduction to a level where they're no longer able to get a tax deduction for that charitable gift. So then what are some of the ways that we can continue to give charitably and still get a tax benefit out of that? Let's look at Albert and Shirley. They're in a 24% tax bracket, and they give $5,000 to charity. They've got $15,000 in existing itemized deductions, but the new standard deduction is $27,000 plus. So because of that, if you add their $15,000 itemized deductions and a $5,000 gift to charity, that's only $20,000. So they don't even meet the standard deduction, and they're not going to get a true tax benefit for that charitable gift. And what can we do about that? We can do something called the qualified charitable distribution, which means that once you reach age 70 and a half, you can give up to $100,000 per year from your IRA directly to a qualified charity, and it doesn't count as income. And once you reach age 72 and you're subject to required minimum distributions, your qualified charitable distributions can count as your required minimum distribution. Here's an example of how this works. Option 1. What's the cost of a non-QCD, qualified charitable distribution, or a regular cash contribution? For Albert and Shirley, the charity gets $5,000, and the $5,000 also satisfies the RMD because they're over 72. They took that money out of the IRA and it went into their checking account. The charity got $5,000 and their RMD is satisfied. But that $5,000 is reported as taxable income to them because they received it in their checking account and in cash. And then they get to pay tax on that at a 24% tax rate, which is $1,200 for them. So the total cost then of their charitable gift was actually $6,200 because they received their $5,000 in cash and then paid $1,200 in tax on that distribution. Option 2. Let's look at it if we had done that as a QCD, and instead of taking the cash out of their IRA, they sent the $5,000 from the IRA directly to charity. And this is something that your advisor can help you facilitate. So the charity gets the $5,000, it satisfied the RMD, and the $5,000 is excluded from taxable income. So the tax bill on that distribution is $0. So the total cost of this is $5,000 minus the $1,200 that it would have cost for taxes there. And I'd argue that it's even lower because you've been saving and that IRA money grew over time. So everyone wins in this situation, except maybe the IRS. The charity gets $5,000, it satisfies the RMD, and it's excluded from their taxable income. Thinking back to a prior episode, a couple's capital gains triggered extra taxes. Perhaps doing a strategy like this can help keep your Medicare premiums in the right bracket as well. It has that reverse domino effect. For a lot of philanthropists out there, once you reach 70 and a half, giving in the form of a QCD can make a lot of sense. We've covered so much this series as we went through 4 key points for tax planning through the 4 stages of retirement, and hopefully this bonus information about charitable giving has helped. Thank you for joining us for WealthWise. See you next time.